Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for April 12th of 2026. Last week, we got the final revision to the fourth quarter economic growth estimate in terms of GDP. You can see here that on the right-hand side, you've got the revisions to overall real GDP. The initial reading was 1.4%, then it was revised down to 7/10, and further down to 5/10 last week. And you can see where some of the issues were, basically we had a big negative revision down here in residential investment. And then most of the other categories were slightly in line, maybe a little bit better in a couple of cases here. Government spending, which in the aggregate has been very, very weak, as well as net trade and exports here. You can see that the number relative to the last couple of quarters is fairly anemic. We were looking at something a lot closer to 4.5% to 5% for a couple of quarters after the negative print in the first quarter, which was driven largely by trade. But you can see that obviously the near-term trend line is a little bit lower, as we'll see in a second. The Atlanta GDP now estimate looking ahead to the first quarter is coming down as well. Here we have that Atlanta Fed GDP now estimate. You can see this is the fourth quarter that we just looked at, with those estimates initially peaking up here and then finally coming in not too far off of its initial estimate. Conversely, here in the first quarter, we see that the initial estimate was over 3%, and then now that's come down to basically about 1.4-ish percent, which itself would mark really the kind of the lowest level that we've seen in well over a year. Here we have personal income, which was negative in the most recent reading. That was below expectations of a positive 0.3 print there. You see real disposable income year over year was 1.1%. And if you annualize the latest monthly data, that would portend to be negative 5% or more. You can see disposable income growth has gone down, has decelerated. And so we take these two numbers here together in the context and trying to discern where we're going to see consumer spending go, which has been a real bellwether for our economy over the last number of years. Here we have savings rates down around 4%. They do oscillate quite a bit over a long period of time. This data series goes back to the 1930s. And you can see 4% in a line of best fit that probably comes in line somewhere around here, which means that we're below the long-term savings rate. But if you look over, take the last 25 years as kind of a proxy for kind of the new normal, you can see that we were at very low savings rates in the early part, mid part of the 2000s, heading into and encompassing the global financial crisis, and that savings rates actually have been coming down because we've been supporting consumption with savings as current incomes have only over the last couple of years on a real basis kept up with inflation. Here we have the PCE numbers. We've got the price index that came in pretty much in line. You got core prices that came in line as well. You can see that price index here has been moving up, which is no surprise. We've been talking about that. That's been transpiring over a number of months now. And then core prices, you can see here, have been elevated for a little bit now. What's interesting in this is I didn't find any particularly compelling data when you look at, necessarily the pro-cyclical versus the non-cyclical components that would contribute into this number. But it is interesting that here we're not talking about housing anymore, because we see housing year over year decelerate. And so what's causing this, and particularly the core PCE here, to move is actually not housing at all. In fact, housing is a dampening effect on inflation right now. As we'll see, the real culprit is goods. Here we have goods pricing continuing to move higher. This is year over year. The bars represent the monthly data, and you can see the last few months have been fairly stout. Now, what's interesting here, and this is something that we know, we observed it, and we have been monitoring it. So the tariff effects. Now, if you didn't have the tariffs, then what you'd be looking at is actually really a deceleration, a very deflationary kind of environment, which would help bring overall inflation down, or I shouldn't say not deflationary, but in some cases like more disinflationary. But we do have tariffs, and you can see the delta as a result of that. It really can be measured, in about 3.5 percentage points here, just from a goods price standpoint. Here we have some data on the Strait of Hormuz. A lot of rhetoric here over the weekend about failed negotiations. So, as I'm recording this on a Sunday, I would expect there to be more volatility in the markets tomorrow. Markets had been expecting a deal and kind of pricing it in. Now it looks like we're kind of back to square one with saber rattling and the U.S. Talking about a blockade of all ships through the strait, which obviously is not what the market is wanting to hear. But the ramifications, I think, are important because they extend beyond just the petroleum side. And obviously, you've got fertilizer, which, we've talked about urea shipments have been very, you've got like, I think, 25 to 30%. You have a greater share of global urea goes through the strait than you do actually in petroleum products. And so fertilizers are made from urea. And so you've got basically, here that's about 32, almost close to 35% of seaborne commodity flows and fertilizers impacted now. And then, of course, you've got all the distillate products, LNGs, natural gas, and then obviously the petroleum products there. And then grains and oilseeds to a lesser extent, but still, just to underscore the fact that this is an issue that extends beyond petroleum. Here we have crude price scenarios. This is from KKR presentation. I think what it underscores is that there's a lot of variability in these estimates. You've got the futures price, which is kind of like coming in here, elevated for a while, but then you've got a high case of 170. And I think all of these are on the table right now. Obviously, 170 would create a lot of tension and friction in the global economy. Even your base case is getting up close to 140, and that's if you don't have a deal for a long time and you get these blockades for a long time, so on and so forth. So a lot of variability in oil prices, and as the longer this lingers, the more that we'd expect it to filter into the production chain. Here we have something else that I think is important for us to think about, and that's just basically stock on hand. So, obviously we're dealing with supply chain choke points with energy because of the closure of Hormuz, which, as we know, is about 20% of global oil transports. And here we've got, basically in this scatter plot of outcomes, you basically, have a situation now where you only have like 52 days of supply in the kind of the base case scenario, and whereas in prior instances you had more days of supply. And so while this does fit along a line of perhaps best fit, and with a fairly low, in my opinion, R squared or kind of a loosely defined correlation here between these data points. Having low inventories heading into a prolonged period of lower supplies is going to be an issue. So we have supply chain issues that we need to be watching. Semiconductors basically being the primary culprit here. Within the auto sector, you've got some supply chain issues kind of building as well. Freight, not so much, but clearly we're seeing something on the semi side. On this side, we've got basically price increases for these various components. You've got Asia diesel, jet fuel, you have Eurozone jet fuel, US, and so on. But in most of these cases where these fuel components, have really more significantly impacted Asia, that's really feeling the brunt of energy prices right now. Here we have some default rates for various components within the credit sector. You've got loans in blue that have really kind of stabilized. You've got European high yield, which has increased here clearly, and loans just in general. You've got US high yield, which seems to have peaked already, and we've been watching this for a number of months now, and has actually gone down. And then there's private credit in this line right here. And, much has been made over, the fear factor that's being priced into these markets, and particularly some of these private firms, semi-liquid business development companies, so on and so forth. But what you see here is, maybe there is an uptick, in default rates, but they're not significantly different than they have been over a longer period of time. And I think this is what's really important, is that it's more of what we're seeing in the market in terms of pricing is driven as much is actually driven more by sentiment than reality, because we're just not seeing this rash of defaults that we have in prior cycles. Here we have employment, impacts by the most AI sensitive. What's interesting, you've got, your top 15 most AI exposed industries where you're actually running negative payroll. And, again, if you look at, the post tariff tantrum environment, we really haven't added any jobs. And a lot of that has been because of the tech sector, where, you've got total private payrolls employment. It's been pretty anemic. But again, if you look at the most exposed areas, they've really provided an anchor on that. Here we have the non-farm payroll. Essentially, what kind of payroll growth do we need to have to maintain equilibrium? That just means that the number of people entering the workforce in a productive capacity equal that of the departing folks, and those aging out of the workforce. And you can see that that number continues to come down, and basically we're looking around, roughly 50,000 jobs a month, and that's down from 150. So a pretty significant change in a short period of time. This is something I thought was really telling, and it really speaks to this K-shaped economy that everyone's talked about. Again, the lowest 20th percentile in income, spend about 17% on energy on an annualized basis, whereas the highest only spend about 3%. And you can see that is the impact when you deal with higher energy prices, whether it be gas prices, heating oil, you name it. That's where the impact is really being felt, and it's very real to them, because it's it takes up such a such a significant part of their discretionary spending, as well as a percent of their pre-tax income here. Core inflation expectation really driven, as we've talked about, by goods. That's pretty apparent. You've got other services here, and then you've got core services. I mean, you've got inflationary impulses from basically everything except for shelter, as we talked about earlier in the chart back. But goods inflation here is really driving this estimate more significantly. This slide really represents a kind of a look back as well as a look forward. We'll first start on the left-hand side here. So on the x-axis, we have trailing 3-year S&P 500 returns, basically at zero, and then you've got your negative returns and then positive returns. And, basically, whether your market on a trailing 3-year basis is negative or positive up to a certain point, you're really looking at 10 to 12% in this bailiwick here. And the majority of which is coming from earnings growth, and that's less so when you have uh, greater performance. And so when you look at this box, this is kind of where we've been here in the last 3 years, and so expected returns are just naturally looking to be lower, and again less earnings contribution. Although, frankly, our earnings estimates have only come up to the tune of 10 to 20%, and a lot of that's driven by tech, granted, but it's still influencing the overall index. And then you're getting a little bit of multiple contraction, and then when you get like really strong 3-year trailing performance, you tend to see those multiples contract. You don't have as much earnings growth, and your expected returns are like 3%. But where we fall right now is in that 5% bucket. And again, we haven't, we've had pretty good performance over a 3-year period. And I think that is causing us, as we move over to the right side, is kind of like looking forward, is like tempering our enthusiasm. And you can see here, this is the last 5 years we've been looking at S&P 500 performance, pretty strong private equity. You got direct lending here, and even cash at some point, over the last 5 years, with interest rates moving a little bit higher, you're getting a little juice on that. Treasuries have been negative, which is a little odd, but you see this increased clustering looking ahead. And again, past is not prologue, so we can't extrapolate too much from this, other than to say, what is reasonable looking ahead. And so, we've looked at S&P 500. We've already talked about expected returns. Just historically speaking, when you have a trailing 3-year performance like that, you're just not going to have generally as much juice there. Now, treasuries looking to be kind of on top of that. And so even still in this environment, you're still having to look at private, and you're having to increase your allocation of private equity, private credit, infrastructure spending, real estate spending as a percent of the total. And I think that's very that's something that we're spending a lot of time on right now, and exactly how we build those exposures within the portfolio will continue to evolve. Well, coming from a perspective of a wealth and financial planner, this slide is very compelling, and this data really speaks to the issue of education, and the issue that it's imperative that we get people more aligned to think about the future and think about their future and planning for that in the early stages. And when you think about it, it's intuitive that you have people at maybe lower income cohorts or less education that aren't thinking about or have access to retirement plans or programs, or again, even thinking about it. But what this slide tells us is that's not necessarily the case for higher income cohorts, that there's still a large part of the population here that do not have retirement program access or even have a plan. And you can see that clearly in the data here. So again, you think those that are in their peak earnings years would be at least thinking about it. Well, no, here you've got 40% here that don't have in the private sector, that don't have a retirement plan. Here you've got even some college and bachelor degreed individuals that don't have, like basically a third of all of those that have a college degree don't have a plan. And then you look at the income cohorts too, and you get over 78,000. Granted, it's a lot lower than the smaller or the lower income cohorts, but still it's very recognizable. You get to 20%. That's basically 1/5 of all high earners that don't have access to a plan. And so this is a challenge to the industry to get more education out there. It's a challenge to employers and obviously legislators to some degree to come in and help inspire and provide incentives for people to save for their retirement. Obviously, we've got 401ks, and we also have vehicles for self-employed individuals and so on and so forth. But again, you got to have the tools, you have to have the legislation, and you have to have the education all in concert to deal with an issue that is leaving a large part of our population exposed to future retirement and prosperity. We've talked a lot about the relationship between gold and 10-year rates, and go back on this chart from Apollo and Torsten Slok. You go back to 2006, you can see this relationship has been extremely tight. This is a very tight correlation, folks. And then we have the invasion of Ukraine, and it's like almost on a dime, we began to see this significant divergence. And so, reasoning here from Apollo, which makes a lot of sense to me, you have differentiation away from the US dollar. You've got China that is lowering its reserves being held in US treasuries and replacing those with gold. And you're also seeing a lot of other central banks, including emerging markets, central banks basically disintermediating from US treasuries and into gold. And I think that's a big reason why you're seeing this huge gap. Now, the dollar is still the reserve currency of the world. China is working very hard to displace that and maybe making a few inroads here as the U.S. has become a bit more isolationist, with the exception of Iran, of course. But at least from an economic isolation standpoint. But I would expect this gap to remain a lot wider and create almost kind of like a new normal following this kind of like point of demarcation with the Russian invasion of Ukraine. Here we have ground beef. This is but one proxy for the grocery bill that is going up. Again, just like we saw the energy cost by income cohort, be a lot higher for the lower income folks. This is hitting them as well. People like their steak, they like their hamburgers. Think about your hamburger, joints, and they're having to buy ground beef, and all those costs are moving much, much higher on a per pound basis. Just one of those salient things that's contributing to inflation. Something I thought was very interesting in the Apollo feed this week was this particular chart, and it's basically a year-over-year look at the impacts of AI by certain job functions. And when I think about the impacts, I think about it like really in the way that this slide is presented. So, you've got being able to generate revenue from new product lines, and so the expectation is that AI is going to be making a bigger impact on that. And you can see AI is making a bigger impact on just about every component of the business function, and more so in 2026 than we saw in 25. When you talk about, basically revenue from new products and quality management, just overall revenue generation, and then you got customer satisfaction, which is a way to create stickiness amongst your customers, and then the optimization to increase productivity. And I think this is a year in which you are likely to see some real tangible gains in productivity from AI, which will translate into output per worker, and then the ability to make decisions faster. I think this is a really, really interesting slide, and I think, as I said, like late 2024, when we were kind of just beginning, like we're really instituting AI as a buzzword. I said it would probably take a couple of years for AI to kind of get embedded in core business operations. Well, it looks like that's clearly happening here in 2026. Here we have some inflation year over year. This is looking at headline inflation, and you can see we talked about this. The variability of estimates and PCE have been all over the map, so there's a lot of delta there. That's translating into policy expectations from the Fed, and obviously next month we're going to have a changing of the guard there. Still not sure whether Fed Chairman Powell will remain on the FOMC, and he's certainly entitled to, even though he's not chair. But when Kevin Warsh comes in here, he's going to be faced with some conundrums. And so basically, you've had some changing in thinking here. So, like back in February, looking for more rate cuts, I'd say for the time being, that's really kind of off the table, right? And then over time, I think 2027 seems to be shaping up for a year of some relative softness. and then maybe we get some rate cuts in 2027, and then that plateaus off. And then I think anything beyond 2028 is purely a crapshoot at this point. Here we have the mortgage market, with rates moving higher based on these inflation estimates. You see mortgage rates moving up. Again, this is not great for affordability. And people were kind of waiting on the sidelines perhaps for those interest rates to maybe drop so they could hold out and maybe get rates in the fives, but obviously is not happening right now. Here we have income tax refunds as we're sitting here on the eve of tax filings. The deadline here, we've clearly got more refunds coming this year as a result of tax law changes that were effective for last year. And you can see that that is not an insignificant amount of money. When we're talking about it, I mean, it's probably 25 billion at this point, and that gap is moving higher. And we should see as we get to filing that number is probably going to be, up here, and it's going to be relatively significant to overall consumption. And as a result, what's interesting here is that we've had a leveling off in credit creation, because we've had a little bit more discretionary income that we saw, and not robust, but again, credit creation is not blowing out like you would expect if we were at the very end of a particular market and economic cycle. We've got earnings prospects that are blowing out on the Mag 7. We've had, as I mentioned before, about a 15-20% increase in earnings estimates this year. And a lot of it is driven by the Mag 7. And what's interesting here is that if you look at the other 493 or so companies in the index, you've actually had some earnings downgrades. And like on a net basis, you've seen earnings estimates actually come down and temper a little bit. They're not falling, they're just not moving higher, and they have moved down from their prior estimates where these tech earnings these estimates have gone through the roof. Now, as a result of higher earnings, that makes the your denominator, and your price to earnings ratio a lot higher. So your PE ratio has actually come down, and that's actually what's happened here. Is you've seen the S&P 500 overall multiples come down, but that's been largely because tech multiples have really come in because you've seen such a blowout in earnings estimates. And I'd say that there is some risk embedded in this, in the sense that if these forecasts of earnings, do not prove if they don't come to fruition, then you're going to see some action here on pricing, and certainly in overall multiples. Here we have volatility, which, as I mentioned, has gone up. We look at that in the context of this slide, in which case we see individual investors are really trading a lot. And so that does help to exacerbate this when you have times of uncertainty. And so this is just a SPDR ETF, and this is the number of times that the SPY, that one ETF, has had more than $60 billion of daily turnover. And you can see here in the last year and then year to date here has been really astronomical. Now we'll talk about credit for a second here. We have credit spreads in the tech industry on the left-hand side. And this chart here is showing tech credit spreads relative to the overall index. And you can see that tech has traded at a tighter spread, meaning a higher degree of confidence within the credit markets than the rest of the market. Well, that has evaporated, and we know that this comes in the context of private credit sell-offs of the issuers like Blue Owl, so on and so forth. People becoming more skeptical over whether software is really going to make it, so to speak, and you're going to have more credit defaults there. And so credit spreads have kind of moved the other way, and they've moved higher than the index, or at least just at it right now. And so what we see here is, basically the tech sector share of the credit markets, and you talk about leveraged loans, and that's about 14%, high yield about 9%, and then about 11% for investment grade. And so tech is meaningful, and you can see that the percent of market value, just looking at a 20-year period, you can see how much that's increased, and we've had a lot more innovation. But we've had a lot more reliance on the non-bank sector for a lot of these, these technology firms. And so, that means it is important. But as I said before, the rate of defaults is not indicative yet of a big credit problem, even if it's beginning to be priced that way. There's a lot of rhetoric in the market that's driving this. And the last slide today will just be a check-in on the sentiment indicators from an investment standpoint. Again, you've got your active managers, your institutional investors. Sentiment's picked up a little bit off the trough. Here's your 4-week moving average, which really continues to show that slowdown. But at least the latest uptick here, you're getting a little bit more confidence in the last few weeks. In a similar fashion, you've got the bearish sentiment that had been really entrenched here and reinforced over a period of months. That's reversed as well. You can see that the net environment is still bearish, but it's less so. So, again, I think these are going to have a tendency to want to move around a little bit. And I think there's a risk that they continue to do so for the foreseeable future, because it does not look like there is a firm end to the Iran conflict. That's all we have for the chart pack this week. I hope you have a great week, and we'll talk to you again soon.